Welcome to another MBS Highway live monthly webinar. I'm one of your hosts, Megan Anderson, along with Dan Habib. And today we have a returning guest. She is a powerhouse in the world of technical analysis and investment strategy. She is the founder and managing partner of Fairlead Strategies, an independent research and investment advisory firm. With nearly 3 decades of Wall Street experience, she cemented her reputation as an important market voice, guiding institution, advisors, and individual investors through volatility. Before founding Fairlead in 2018, she served roles at BTIG, MKM Partners, Morgan Stanley, and with Soundview. She's also the youngest female to earn the prestigious Charter Market Technician, or CMT, and she is a sought-after voice on CNBC. We've seen her in major publications like Barron's and the Wall Street Journal, and today she is here to walk us through some important technicals. So without further ado, join me in welcoming Katie Stockton.
Yep. Megan, I am very excited for this one. You know, you guys, some of you have seen Katie before, but she is widely accepted as one of the best technical analysts in the world. She's regularly featured
You
on
guys are
things
too
like
kind.
CNBC and such. And listen, there's been so much volatility. There's so much headline risk out there. I know personally, I am very excited to hear Katie's thoughts on where a lot of things are headed, like the S&P 500, the dollar, the 10-year, cryptocurrencies, you name it. So, Katie, welcome and thanks so much for giving us your time and joining us.
Thank you so much. I appreciate the intro. It was obviously very generous, and those 3 decades, wow, I'm feeling those 3 decades now. It's been really very interesting from a technical perspective when we see such volatility. It is sort of like our, game time, and we have so many things to talk about, but it's a very top-down oriented market when the market goes lower. So you can just focus on the major indices in terms of guiding your positioning. And that's what we've been really spending time on.
Katie, before we get started with like specific securities and such, I actually am curious of this myself, and I'm sure others listening would have a similar question. You predominantly focus on the technical analysis, but there has been, as we talked about in the pre-show, a lot of headline risk, whether the tariffs are on, if there's exclusions and whatnot. So how do you factor that into your technical analysis? Do you believe that it's kind of all already in the charts? Do you pay maybe less credence to some of the technical analysis and use it as guardrails at times like that? How do you kind of look at that?
I don't mean to be flippant, but I would just say there's always something. There's always something out there that is a big risk, right? And it changes. The risks are different during different cycles. But the headline risk is often there. I would agree that it's pronounced right now and really since the inauguration. And yet the charts should be incorporating all the known information. All the headlines boil down to ultimately a buy or sell decision, or I guess a do nothing decision. So we already know what the reaction is on a preliminary basis to what the headlines have been. And we have no way to predict what the headlines will be, right? So rather than try to do that, we will use our indicators, things like market sentiment gauges, the volatility index for one. We'll try to use those to help us understand the short-term risks to the market from a technical perspective. And then, of course, we'll always take that within the broader context of the long-term indicators, which I think we give the most credence to in terms of our short-term positioning. We'll defer to those long-term metrics as a way to provide guidance.
Awesome. Well, thanks for that explanation. And boy, volatility certainly has been bouncing around when you look at the VIX, the move index for the bond market volatility. So let's start with what a lot of people are paying attention to and making a big noise about in the media, which is, and even our ex-Fed chair, as well as Treasury Secretary Janet Yellen, she was kind of sounding the alarms about the fact that we've had the dollar moving lower. At the same time, simultaneously, as the 10-year yield has moved higher, it actually touched 450. Now it's since come down to about 431, 432. But a lot of people, after especially Yellen saying this, they're trying to discern from this that, hey, maybe the dollar is not going to be the reserve currency of the world. Maybe people aren't interested in our treasuries anymore. So, Why don't you break down maybe where something like the dollar and the 10-year is and where you see that going?
Yeah, no, and I'm happy to share my charts too. Hopefully they're the visuals okay on your end. I will make them bigger than this. I feel like the action in treasury yields right now is really fickle, for lack of a better word. We've had almost like a directionless period for them. So as much as we've seen volatility in both directions, the end result has been somewhat neutral. So if you look at this is the daily bar chart of 10-year yields, and you can see they, for a while, were tethered to their 200-day moving average, which is that purple line, came down and then snapped right back. So I'd say they're still somewhat tethered to this very flat 200-day moving average, which that flat MA is reflective of a long-term trading range that has bound treasury yields now for a couple of years even, you could argue. So that bias is neutral. So I would say neutral, intermediate term, and arguably longer term. There are indications that we should see yields ultimately move out of the range to the upside, and these are long-term indications. So I don't think it's a near-term concern or probability that's high. But this is the monthly chart. And we have been in the camp for some time that we've seen a secular shift. So if we go way back to the early 80s or even beyond, you can just see this long-term downtrend or secular downtrend appears to have been reversed. So we believe there's a secular shift that's occurred. And so we're seeing this range as a consolidation within that secular shift. But our models, including the shaded area, which is our cloud model, do suggest that we'll ultimately move out of that range to the upside, which means above 475, likely above 5.25, where there's secondary resistance. I just don't think it'll happen anytime soon. I think the bias is more neutral here near term. What we have our eye on to that end, though, is this is the momentum gauge we track. It's the MACD indicator. And you see as it's gone somewhat sideways, the momentum's upticked a bit longer term. That doesn't mean anything from a short-term perspective, but it does reflect that within that sort of weakened momentum context over the past year plus, it's actually getting less weak. So it's a nuance and probably is in no rush to break out. But that's something that's in the back of our mind when we're looking at it. You're right to suggest that, there's a little bit of a pullback underway, right? So a retracement. This is another daily chart. You see this little short-term downturn here. That suggests over the next week or so, we'll see them come off a bit.
Is
So
that your
as they're
stochastics below there? Is that a stochastic?
That's a
Yeah.
stochastic, and that's, I'd say, one of our most sensitive market momentum gauges, that type of thing. And it does suggest that we'll see yields move a little bit lower over the very, very near term, but we're expecting that 200-day to remain a tether until that momentum shift longer term becomes evident. So more of a neutral, directionless bias that doesn't really help us at all. It kind of serves as max frustration, I feel like. But it is what it is. It's when you can't have a strong directional bias. I think it's okay to be neutral and wait for something that's a little bit clearer in terms of the evidence.
So Katie, it looks like the 200-day is around like 423 or so. So you think that it's going to kind of be tethered to this, and you, it sounds like, think that we've broken out of this long-term downtrend in yield, and you're probably seeing 5% before you see 4%, right? And you think that it's going to eventually go above 5%?
I wouldn't rule out a sub 4% reading before we get out of the range. The reason for that is that the range support longer term is more like 3.6 to 3.8, and that's very simply based on previous lows. You could look at it on the monthly chart.
And,
That's
and
about
by the way, in
3.8.
our forecast, Katie, we have as a target range 360 to 380.
Oh, there you
Uh,
go. And yeah,
yeah.
you can't rule it out. I mean, this is sort of the support zone. It's an important support zone at that. So I wouldn't rule that out. It's, especially as it just remains in this volatile sort of week over week activity, which you would argue that the headline risk could create that, continued uncertainty, right? So we're with you on the possibility that it dips further. I just don't think it'll stay there very long
Hmm.
and will ultimately emerge. The timing of that, we just have no idea. But as we see this MACD start to become a bit pinched, that's where we're going to start to pay attention.
Now, I'm sure that you've seen a lot of people have increased their odds of a recession this year. Even, if we don't see the tariffs bounce back up and they stay at this baseline of 10%,
Mhm.
how would you think that that would influence things? I know lately we've been seeing some disconnection where normally you would see the stock market, if that's moving lower, oftentimes money's going from the riskier assets of stocks into the safe haven, the bond market. Or I think some reasons for that lately. There was a big unwinding of the basis trade, which is a very, very sizable trade, and treasuries had to be sold there. But um, what do you think about if we do, in fact, see a recession? Does that change your outlook as far as this going above 5% and maybe having a little bit more of a durable time at lower yields?
Yeah, listen, I mean, it could extend the duration within which it kind of stays in this more neutral mode, I would say, or preserves that more sort of like weaker long-term momentum picture per the monthly MACD that we looked at. Short-term treasury yields, I feel like the credit spreads look like they're going to widen, and this is strictly from a technical perspective. Short-term treasury yields, it's hard to say, but I think of it more as its implications for the equity market. It certainly I'll show you a chart here. Certainly when you see credit spreads widen, it's not a great environment for equities, as you could imagine. And so that's what we have on our radar. And there's undeniably been an influence on market sentiment that's meaningful, and I think it's rightful. So if you see this chart, this is credit spreads. We have a formation called a double bottom
Hmm.
that appears to have developed here. And those double bottoms, they look like W's on the chart. They tend to give way to somewhat prolonged up moves. And so that's what we're a little bit worried about here as an indication of a recessionary environment. And just, you can kind of eyeball the past periods, and none of them were good for equities.
Yeah,
So that's on our mind.
well, thanks for that. Yeah, our subscribers, obviously in the mortgage arena, you know, they're trying to figure out, is there going to be another big refinance opportunity? We had last year some very good evidence that if we see mortgage rates on a 30-year fix come down to around 6%, there's a big uptick in purchase as well as refinance demand. So I think if we were to get down to, let's say a 380 on the 10-year, that would coincide probably with around a 6% rate. So, boy, I hope that, we see it at least go there for a bit, so we have that opportunity before.
Yeah, and I would just say if you see it, grab it, right? Because because it would probably not stay there very long if indeed there has been that secular shift. So if you look at this is national mortgage rates. Here's the range there. You can see it having manifested itself there as well. Not quite oversold yet, longer term. This is on the monthly. But you do still have that same uptick in the MACD histogram to suggest that it will, sort of stay relatively high, I guess, relative to the recent lows. So would defer to that for now and take advantage of any dip.
And we've seen, one of the big influences on inflation be oil prices, and oil prices have come down pretty sharply. And I believe you have some pretty significant targets that you've been kind of outlining and identifying.
People are a little bit upset by it, admittedly. The next support for crude oil, looking at WTI, is around 45 in our work. And that does not mean that it has to go there, but we can't make up these levels.
Hmm.
We have traditional ways that we derive support and resistance levels, and this is just simply based on our methodology. And you can see on the monthly chart, you can see the magnitude of the breakdown. So we believe this was a triangle formation and a breakdown. Here's the next support. It's based on our cloud model. We have like a little bit of an issue with that dip, of course, in 2020, that to negative territory that throws off some of our ability to use our trusty Fibonacci retracement levels. So we're left without, multiple ways to drive support. So it is what it is. It doesn't mean we have to get there, but certainly the breakdown would suggest that we'll see downside follow through for the coming months in crude oil prices. And we're seeing it also in energy sector proxies like XLE has a big breakdown from what looks like a topping formation. So unlike 2022, let's assume we're in a bear cycle for equities. 2022 saw massive outperformance from energy, and energy can have a completely different character from the whole market, just because of its nature and the tie to the commodities. However, this year it looks like it won't be that year. So if we have a bear cycle, I don't think we can trust that energy will be that source of outperformance again.
And at least in my opinion, just kind of making an argument for maybe why we would see yields come down to maybe the 360 to 380 range before resuming an uptrend, is that if we do see oil even come close to your levels, of course, headline inflation is going to be significantly impacted, but even the core, it trickles into it pretty significantly through things like airline fares or any good that's manufactured and shipped. Oil is going to be a key component. So, if we do see some of those targets on oil, hopefully that does help inflation move lower, at least in the time being, which I think could certainly help yields to move down as well, since it's one of the main influences. You mentioned the stock market potentially being in like a bear market here, right? Or it did reach bear market territory, but are you seeing if we look at the S&P 500, are you seeing us maintaining this recovery? It looks like we're up about 600 points on the SPX from like the low, but we've seen some technical developments like a death cross. Do you think the highs are in here already previously, and we're going to continue to kind of lose some of these rallies?
Yeah, I would say that the longer term indicators suggest that we do have a pretty important high already in place. It's obvious now, right now that we've had breakdowns unfold. But the short term does paint a rosier picture. We track something called the DeMark indicators, and you can see them on this daily bar chart of the S&P. Let me just circle here. This is the sell signal that we last had based on one of the models, based on this little 13 that you see. And we had a buy signal on April 8th to suggest that we'll see a little bit more upside. It only has implications for a couple of weeks, so it takes us into next week. But it's being enhanced also by a couple of counter trend indications, or effectively oversold buy signals on the weekly chart as well. You see this as another DeMark signal, this 9 buy and this oversold upturn. Taken together, they would suggest that we can get maybe 4 weeks out of the oversold bounce that's underway. So for those that miss the opportunity to reduce exposure already, I think that they might want to think about doing that into this rally. We did see a lot of breakdowns, of course, with the reaction recently to the tariffs. And even before that, we'd had pretty meaningful deterioration on the monthly charts. You can see that here. This is the monthly SPX. And I would imagine, even non-technical analysts can see that these downturns are somewhat meaningful, right? We'd had this crossover here was bullish, and this is bearish. The last time we had the current setup and the indicators was right here. And of course, we were still early stage bear cycle 2022. So we are making that comparison. And then we also had some counter trend signals back here. Those are those DeMark signals. Again, that was November, December that we got some counter trend issues that had already affected some of the mega caps. So that sort of combined with the loss of leadership from the mega cap complex, which you can see here, this is the relative performance there. That's pretty meaningful. So it suggests that we're not going to get out of this quickly, probably, but we'll at least have some short-term relief. And that might be something that presents an opportunity for people to reduce.
Very, very interesting. So, when we look at some of the investments in the stock market that you're liking, or you're looking at as good opportunities, I mean, I hear some people saying that they should be selling, like I think you just mentioned, into any strength that we see. Some people saying that it's a really good buying opportunity with the downtrend that we've seen. What is leading you to believe, and maybe you could explain, a lot of our subscribers are technical and they get into the charts quite a bit. I know that many of them probably don't know what the DeMark indicator is, or even the MACD, which is a momentum indicator, but how does that kind of influence what we're seeing out there? It looked like every time we got close to like a 12, that was a signal, right? So maybe you could just, without going too deep, explain that. And
It is hard to explain something so mathy, right? But if you think about the DeMark indicators, of which Tom DeMark has a suite of dozens of indicators, and I'm typically just using two of those indicators that are designed to gauge trend exhaustion. So he's brilliant. He's done a series of sort of trial and error calculations on various like price qualifier. So an example to assign one of these sequential numbers that arrives at these signals would be you're comparing the close relative to the close 4 bars ago. Is it higher? Okay, yes, assign a 1. Does it happen next week? Assign a 2. So there are these various like qualifiers, I would say, that the price bars need to meet in order to run these sequential counts, which ultimately get us to that trend exhaustion. Why they work, there's probably some basis in the Fibonacci sequence that does manifest itself in the numbers. And he's just onto something is what I would say, having done this for many decades. And I find them very valuable, but we use them in conjunction with other indicators. So we'll use them with the MACD, we'll use them with the stochastics, with support and resistance levels in mind. And I think it's taken within that context that they have the most value.
interesting. So to summarize that in layman's terms here, if every 4 days you're seeing a higher price than a higher closing price than 4 days prior, and you continue to see that sequence happen, let's say 12 times, it's a sign of exhaustion and that you'd likely see a move in the opposite direction.
Yeah, and there's additional qualifiers that I won't go too deep with, but I would say that the idea is that as you progressively close near the high end of a range, kind of like what the stochastics are measuring as well, the I guess you're supposing that it's getting more and more overbought or overstretched, right? And there is a point at which you typically see trend exhaustion unfold. So we use that. We use it with other overbought, oversold metrics, but that's kind of the category that I would put those DeMark indicators in, and it's been very valuable when the moves are this extreme. We also use our market internals. Those are things like sentiment and breadth and leadership, which have blown out to massive levels. I'm sure you could imagine what the action that we've seen has done to those metrics. And it serves as a great case study in a way of the value of these indicators. But oftentimes the readings that we have that are so extreme, they're mistaken as being long-term indications, when in reality, they're typically only short-term indications of tradable lows. So we, get excited about these VIX spikes, right? And a VIX spike is typically a short-term positive for the S&P 500 from a contrarian perspective. But a spike up to 60 would actually suggest that we've gotten into an environment that should be characterized by elevated volatility for some time, even if it's not 60, that the new floor is higher.
Now, listen, we don't ever try to get political and such, but based on what's happening right now, and people could have different reasoning for why the Trump administration is doing what they're doing, but let's say that this move that he's doing, where he's trying to get better trade agreements with our trade partners across the world. Let's say that since there's supposedly 75 countries that are ready to negotiate, we get some really favorable trade terms, that the tariffs do get dropped in those scenarios where the reciprocal tariffs on the other end are removed. Maybe something happens with China where we're able to come to some type of an agreement. Does that change your mindset as far as us still being in a downtrend for the stock market potentially, and prices not being higher a year from now, or how do you think about that?
So think of us as dealing more with the what and the reaction versus the why, right?
Hmm.
The charts are going to reflect all the information, so we have to trust the price action is helping us to understand when there's a greater probability that a key low is in place. And I'll show you just one, I'll give you an example because I think it's probably the best way to impart this. One of the things that we do look for, and you'll see also why it doesn't, paint a picture that suggests that this is going to be over soon. This stochastic oscillator as an overbought oversold metric, when we have an overbought reading and it's being sustained, that tends to be a positive development, right? So we had that up until here. So we just got a fresh downturn. So it's a pretty new, what we call overbought sell signal. So where we start to get interested again as like a potential longer term low, not just a short term low, which as you know, we were on board with, but a longer term low would manifest itself in a way in the stochastics, probably initially. So like here we had, this was a little bit of a stronger tape where we, believe it or not, even 2020, where the stochastics only needed to go to 50% to get us these entry points that were really very meaningful. So we could theoretically see the stochastics come down to around that level and turn up. That happens more often in sort of secular and cyclical bull markets. Because the MACD is suggesting that we're in a cyclical bear, well, we're guessing that we might need to get closer to oversold territory on the longer term stochastics before we have that final low. So at a very minimum, we'd want to at least see the monthly stochastics turn up. And you can see how common these retests are, super common of that oversold territory. So that first oversold reading is not necessarily the buy signal, right? It's usually the second one. And you can see how that would just probably take a lot of time. We're talking months, not years, but up to a year or so to get to that place where we have an oversold buy signal potentially. When it happens, whenever it happens, we'll react to it accordingly, but it seems like it's pretty far off at this time.
So just to kind of summarize some of the stuff that we've talked about so far, and correct me if I'm wrong on this summary here, but it sounds like you think that number one on equities might be a good idea to sell into strength because you think that there's more downside ahead. As far as the bond market goes and treasuries, there's certainly a chance that it could go down as low as 360 to 380, especially based on some of those technical support levels. But you don't think that that's going to be too long lasting. So if that does occur, certainly jump on that opportunity if it does even. And you think oil prices could go even lower and potentially support is around $45. It doesn't necessarily have to get there, but it certainly has the opportunity to.
I think that's a great summary. The support levels just in general and resistance too, these are guidelines, right? So they don't act as magnets per se. So that's why we give a little bit more weight to our indicators when we're trying to identify whether something's bottoming or topping. So we do get the question oftentimes, you could imagine that, people say, well, where should I add exposure? What S&P level is the entry? And we can give support levels, but it's really more of like a setup that we're looking for to trigger that reentry. And we also have to reconcile the time frames. So that's the nuance of it. It can be pretty tricky, but we will be very quick to change with the market as it changes. And I think that sort of fluidity is important. None of us can predict where it will be at year end. We're just trying to put more of the sort of weight of the evidence in favor of our positioning. And we feel like right now there is still quite a bit of risk. And in terms of support levels, we are watching one. There's Fibonacci's for the S&P right around 51.26 to 51.33. So that's our first major support that's in play right now. Secondary to that, we could see that if that level's broken decisively, so like a couple weeks below, the objective using the Fibonacci's, which I know you all love, would be closer to 4,500. So, not to say we're making that our target, but risk would certainly increase if that support's taken out decisively. And based on what we're seeing in those long-term indicators, you can't rule it out.
I love how you're always looking for, a confluence of things and a setup in your determining of where you see things going. And I also like that you're open to, changing your opinion potentially if the facts change. There's a famous saying, when the facts change, I change my mind. What do you do, sir? right?
Yeah.
So yeah, things are extremely fluid right now in this market, and I see a couple of the comments here talking about Besant. You know, Katie, I don't know if my father shared with you, but he actually had a chance to speak with him for about 10, 15 minutes, and it was
That's
very,
really
very
cool.
interesting. He talked about how his target for the 10-year was about 390, and some of the ways that they may achieve that, at least in the short term. He talked about less issuance through less spending, maybe Doge cutting some things, but also the issuance that they're doing, having less on the long end, more on the short end. So there's less supply that has to be absorbed. Also talked about how the Fed, since they've slowed their balance sheet runoff, the reinvestment of that, he thinks in conjunction with the Fed, that's going to be potentially more geared on the longer end, like 10 years and such, which can help yields come down. He also thinks that bank deregulation, once that's finalized and passed, he thinks that can lower some of the wider than normal spreads we've seen between the 10-year and a 30-year fixed mortgage. So, I hope he's successful in
Well,
that.
yeah, no, I think it's really interesting and gives one a little peace of mind too. So, if there is sort of a targeted range, then maybe the range that we already have in place, still with that volatility can be expected, but maybe it'll stay range bound a bit longer. And it is much more fun to be bullish on equities, by the way. So we do hope we hope we're wrong, and we'll react accordingly. But for now, the risk seems pretty heightened, and we'll just stay tuned to it. We wanted to talk about Bitcoin, I know. So
Yeah, a lot of
we,
our subscribers are definitely very interested in Bitcoin, Ethereum, and I'd love to get your take because we've been seeing a pretty high correlation between crypto and stocks, right? So, are the
yeah.
charts telling you anything different there, or do you think that's a similar story to what we're seeing, or your opinions on the stock market?
It's somewhat similar. The volatility hasn't been as crazy, which is sort of crazy in and of itself, right? You'd expect it to be wilder, but this has really been a very equity specific move in a way. So with the Bitcoin chart, what I will show you, and this is sort of unfortunate, is that we've seen the downturn here on the stochastics to suggest that we are going to stay in this kind of corrective mode. The MACD is not yet indicating a bear cycle per se. So we have a neutral long-term bias at this time. And our long-term is something more like 6 to 12 months, not longer than that typically. So we have a neutral bias. When we see opportunities, we would still take advantage of them. Right now we have an oversold condition, just like we do for the S&P 500, not far from the rising 200-day. Support's quite strong, just shy of 74,000 here. So there is support. It is pretty oversold. We could see it maybe moving higher off of that support a little higher, but it does also face resistance on a short-term basis on the daily chart. So, being a risk asset and with that positive correlation to equities, we're kind of in the mindset of, well, it probably has short-term upside, but a better seller. There are some asset classes like Bitcoin, like gold, that have the lower correlation assets to equities. I think there's always, a case for having a small percentage in them regardless, or something that's quite different like Bitcoin from equities, even if the correlation's there. So I believe in having sort of the call option type of position where you're at least there for if it does just explode. Because I think the only guarantee is really volatility. And when Bitcoin does see upside volatility, it's pretty hard to catch it. You can just see it back in November. It was, you feel like you're chasing. So I think it's okay to still have some small position, is my point, within a broader portfolio, depending on your risk tolerance. But I think it's probably more of a neutral to lower type of year for Bitcoin as well, alongside equities. So
It's very
yeah.
interesting. I do quite a bit of work in the crypto space, and we are right now at a period of time historically where you would see Bitcoin sometime this year moving much higher in the entire crypto market because of the Bitcoin halving event that happened around April of last year, where every 4 years the supply coming into circulation every day gets cut in half. So we've never seen a breakdown like this where it was lasting and we didn't eventually see go and set new highs and such, and have more of a parabolic move to the upside. I will say though, while I'm still somewhat optimistic, it is a little bit different because we've never had like a recession bear market per se, besides very short lived, during one of these periods of time, really since Bitcoin's been trading in existence. So there certainly could be some differences this time around, especially with the correlation we're seeing with risk on assets, and also some of the players involved now, right? Where if they're selling stocks, they're likely probably selling some crypto too. But at least in my opinion, I am very, very bullish longer term. And really it has to do with the scarcity issue of it, where you have
Yeah.
almost 20 million of the coins mined, and there's only 21 million that can ever be mined, right?
I mean,
So
you can certainly make a case for it from a supply demand perspective, and the longer term indicators are at least neutral. The catch is that in 22, we did see a bear cycle for both equities and Bitcoin. So it has happened. It still yielded basically a higher low, right, from a long term perspective, but it was pretty painful in the interim. We don't have indications exactly of that yet, but it could shift that way. So we're just more like happy to be somewhat on the sidelines, or small in our positioning. And then, once it does show that momentum uptick, we'll be quick to revisit it, because as you mentioned, it does have the tendency to go somewhat parabolic. So it's like it stair steps, and the stairs can be kind of rough, but once it gets out of it, it's pretty explosive.
what do you think about gold? It's obviously hit new highs, and it's been on a tear. Where do you see that going to? I mean, we're kind of
So
in price discovery mode here, right? But
yeah, yeah, that's a good way to put it. So we actually can't, get an upside objective for gold that's above where we have it. Like we had a previous target at 3060. So we can't arrive at another objective, which is tricky. Let me share my screen here. Because we don't have a fresh breakout. And usually to assign what we call a measured move objective, we need a fresh breakout, but rather this is just a persistent uptrend, right? So
mhm.
so rather than trying to find a price objective, we're just trusting the momentum for now. It is maintaining the overbought reading long term. You see that momentum is still to the upside and also growing. There is an exhaustive signal potentially from the DeMark indicators, but it's not one that we would react to unless we saw some reaction to it, right? So we are going to watch that momentum very closely. But for now, it remains one of the strongest uptrends in the global marketplace right now. So as a place to be, I think it's a good place to be and a safer place to be than a lot of risk assets. So we're pretty comfortable with it without being able to assign an upside objective. We like, as just a rule of thumb, when we have a steep uptrend like this, we like to keep the slope of our 20-day moving average on our side. It's a pretty short-term moving average, that blue line there. And when it rolls over, you tend to have at least an impetus to maybe take some partial profits, right? So that last happened back in early November. Would have been an okay time to be a little reduced in exposure. So just as a good thing that is easy for people to watch at home, I think that 20-day, just keep it on your side.
Any of the other precious metals that you see any kind of interesting setups on, like silver and things like that?
Yeah, the silver actually had a bit of a dip recently that showed, I think, some vulnerability, especially relative to gold. So I think it's not being treated in the same way as that safe haven asset. And then if you look here on our weekly chart of silver, you'll see also an active sell signal on those DeMark indicators. So we're a little concerned by the downdraft. We're also welcoming, of course, of the rebound. So we're making recommendations to our clients to think about paring back, if not closing out silver positions into the strength that we're seeing. Just to keep the gold, but maybe start to reduce the silver, just given that higher beta type of action. Most precious metals should still outperform, and I wouldn't rule that out, silver versus equities, but silver versus gold looks pretty vulnerable.
Now we have a lot of questions in the chat box. People would love to take a look at XRP.
XRP, here we go. So this is Ripple, I trust. Hang on. Okay, so the cryptocurrencies will be really, generally positively correlated. So where we can find some opportunities is usually in relative strength terms. This is the weekly bar chart. You can see here was its parabolic move or steep up move into a corrective phase that is similarly somewhat oversold, like Bitcoin. Probably bounces off of that alongside it, just like a little bit of a short term up move. Resistance being closer to about, looks like 243, 246 on the daily cloud model. So short-term upside in response to the oversold condition. But I would imagine here, yeah, we have on the monthly chart that same corresponding downturn. That would suggest that we probably have a few more months of this kind of corrective price action. So I wouldn't be rushing if you're looking to add exposure to Ripple and to really most of the altcoins, knowing that their relief rallies might be fleeting. We have a weekly cryptocurrency compass report, and I'm going to show you the rotational work that we do in that report because it's pretty interesting. And if you're looking within sort of the top 10 cryptocurrencies, we have them here. This is pretty cool. It's like a data visualization tool. I don't know if you can see it well enough, but it shows the various altcoins and their trajectories relative to Bitcoin. Notice like everything has been pointing kind of down and to the left, which means that the altcoins have underperformed. But in the coming weeks, I think the rotation that's typical for this graph, we should see a little bit of relative stabilization, which would suggest that we have firmness in the near term as we're expecting. The best positioned altcoin in this graph is Tron, for those who care.
A lot of our subscribers want to know if you can go a little bit deeper into what's probably the most important for them, which is the 10-year Treasury. So a little bit of a deeper, or maybe we could just revisit it and go over some of the things you're seeing once again, and a little
Yeah,
bit deeper in the predictions.
yeah,
Yeah.
both on your short term and kind of long term.
Of course, yeah, for sure. So why don't we start with the long term and then kind of zoom in because that's I think usually the way we approach markets.
Hmm.
We let that longer term, I guess, guide us on the short term. So this is the monthly chart. Do you see the screen? Am I screen sharing? Yeah.
Yes, we could see it.
So this is our range with the bottom boundary between that 3.6 area, 3.8 area, and the upper boundary around 475. So
Hmm.
that's our range, pretty well defined range at that. This would be sort of a neutral to lower indication on the monthly stochastics, and I would say a neutralizing momentum situation per the monthly MACD. But it's less to the downside than it was back in Q4. So it's starting to show, indications of stabilizing within this trading range. So that would suggest that that 3.6 to 3.8 level, if it is retested, would hold as we lose that sort of downside momentum that it has had for more than a year now. But you could see also, I wouldn't be terribly surprised to see the range keep hold for a few months. And also that support is bolstered by our cloud model, which is around 365 towards year end. So as another reason for that level to potentially hold. On the upside, if we were to clear the boundaries of the range, as much as 5 is a psychologically significant level, the next real resistance is about 5.25. So 5.25 to us would be targeted, at least initially, by a breakout from the range if we do see one. So here is the weekly. The cloud has been invalidated, so I wouldn't focus on the shaded area, which is often invalidated in trading ranges like this. But you can see better also the support levels right here and here. So
Hmm.
that's the initial support range and the resistance here. So importantly, we talked about how we wait for a couple of weekly closes above or below. This would have been a false breakout. So we pushed above, but came right back below the following week. So for a breakout, we want to see 2 weekly closes above. I'm not saying we want that, but that's what we would require. And then on the downside, it would be the same way, sort of more important, this 3.6 area than the 3.8 area, longer term. So we had this oversold upturn on the weekly, but it's contrasted by an overbought downturn on the daily. And this is always tricky
Mm-hmm.
because it's, what do you give more weight? And I would just say the oversold upturn on the weekly would suggest that this low is an important one. But this overbought downturn suggests that this move, which is obviously explosive, will be partially retraced, right? So I wouldn't anticipate that we see the 3638 right in the near term with this
Maybe
pullback.
4.
Yeah. Yeah, I would say maybe not quite as dramatic. If I were to really zoom in, I'd probably take a retracement here. The 61.8 retracement would be about 414
Mm-hmm.
um, as like a very near term potential level for the pullback to go to. But that oversold upturn on the weekly would suggest that we probably have just a more stable environment from there for a while. So we don't know when 36 to 38 would be retested, if it's going to be retested, but it doesn't look like it's a near term goal for
Now, do
yields.
you think that means, just to kind of give us an idea of the time frames you're thinking here or talking about, is that something that you think could potentially happen sometime this year, or is this a later story? It's very clear, like you illustrated there, we're in a very well defined range, right, between, let's say,
Yeah.
36 to 38 and then 475. What would tell you from a charting perspective, or give you more confidence on which way it's going to go? Because right now, I think you mentioned it's somewhat neutral-ish, right? So,
Yeah, it's kind of neutralish in the range. So I'm personally going to be watching this for that indication of a potential breakout or not, right? So the fact that we've had this MACD on a so-called sell signal, this would be in yield terms, right, for uh, more than a year. It can last longer than that, right? Like here we had a 2-year swoon. Um, but I would say that it gets to the point where it's a little bit above average in duration. So that's why we're going to start to focus on the MACD and the histogram. If it starts to become very narrow and pinched, that MACD, it means that the downside momentum is alleviating. And that would be, to me, the indication that we could be in store for a breakout. That could honestly happen in the next 3 months. It could take 6 to 9 months. We just don't know. So we just react to it as it unfolds. But I would guess by the way it's going that it's before year end that we do see that sort of narrowing and potentially ultimately a breakout. The breakout, you could infer with that in mind that maybe it's a 2026 type of event, but we'll just have to roll with it as it unfolds.
I see a question here, and obviously none of this is financial advice, and it's for information purposes. But somebody had asked here, is there any investment opportunities that you're seeing out there that looks like a great setup, or that's sticking out to you, that you think might be worth a little bit of a closer look?
I was sort of joking because we have a presentation next week that I had to prepare some slides for. And we chose the title of that presentation months ago. And I chose What's Working in 2025? Where's the Momentum? And if I had only known. So here we are, looking for sources of upside momentum. And I'm looking for my slides here. Where is the upside momentum? It has actually been Europe and selected, I'd say, emerging markets. We've seen some better momentum, but they too look vulnerable to us in absolute terms. So it's almost like we're left seeking relative safety, right? So when we see bear market cycles, it tends to leave no stone unturned by that, and then we just are at the place where we're just looking for anything that kind of stands out. So I'll just show you a couple of things that I am highlighting as sources of upside potential. We had Berkshire Hathaway as one source. If you look at the positive momentum behind that stock, so there are about within the S&P 500, I'd say about a fifth of those stocks still have weekly MACDs that are positive, like Berkshire's. So there are stocks out there that have okay momentum. They're mostly consumer staples, utilities, that just sort of safer groups, insurance companies. I'll show you the insurance one. Defense would be another area. So I'd say within the equity market, the safer sectors are certainly the source of the momentum, both in absolute and relative terms. This is the insurance ETF. It doesn't look like a great entry, but it's better than sort of average in the way that it sets up. I'll show you on, this is the developed global. You can see it's sort of neutralized. So probably pulls back with US, but not as dramatically, I would guess. And then the other thing we highlighted here is China. Long-term upside momentum is still intact there, but within that context, you can still see these pretty severe retracements. So we're not eager to add exposure quite yet. Relevant to this group and this conversation would be looking at currencies. The euro, you can see on this monthly chart, has pushed through some pretty major resistance, and yet the shorter term would suggest that we're a little overstretched here. So I don't think now would be the time to build euro exposure, but into the next pullback, that might be something folks would consider if that's something that they're willing to invest in. I'll show you on the dollar index chart, which is the dollar index is very heavy euro, and you can see here on the monthly chart a pending breakdown below the cloud and below previous lows. That's a pretty big deal. In our work, it would suggest that we're going to see it continue to kind of flounder. But here in the near term, the dollar does look higher off of an oversold reading and within reach of one of these DeMark signals. This was a sell signal. So we're looking for a little short-term recovery for the dollar against the euro, and then we might think about adding exposure to the euro.
I'm seeing in the short term, at least, it does look like, it tested some of the support levels from July or so of 2023, and
Yeah.
it looks like it's trying to create at least a temporary rebound here, right?
Yeah, I think a temporary rebound can be expected with that, support. And also, if you, I'll show you the euro on the daily chart. You can see also with this strong up move and the potential breakout, you see that it does have a short-term sell signal. So with this sell signal, you'd expect a 2-week pullback typically. That would be the normal implications of that signal. So maybe a dollar bounce that's in accordance with that.
A couple other stocks some people are asking about is Apple, which has been very volatile with some of the news where smartphones are going to be exempt from the tariffs from China. But then you had Howard Lutnick come out and say it's going to be temporary and they're going to carve out their own kind of tariffs for smartphones. So a lot of uncertainty there, but I know Apple really did take it on the chin a bit, but then had a rebound on that news. So where do you see Apple? And then also if we could take a look at Tesla.
Yeah, by all means. So we have downturns for Apple, as you could imagine, on that monthly chart. So, and it follows what was a big sell signal on those DeMark indicators. So we're holding the same view for Apple as we do for the S&P 500. We want to respect these downturns, and therein view any short-term strength as counter trend at this time. But we are, and for both, we are also seeing this as like a cyclical down move potential, not a secular down move. Look at this cloud. You see how it still points higher for Apple. So once we have a better setup in our long-term indicators, we will be interested in revisiting it. I would imagine it occurs. I sure hope it occurs, above this cloud-based support. Because that would make it look pretty compelling longer term. And then near term, I would look for more of a bounce. It's not short term overbought. It came up into this gap, which is usually a good thing. You'd like to see things come back into their gaps, and you see it starts to come into resistance around its 50-day and at the cloud. So about 223 plus, there's some resistance that kicks in. So for those that own Apple, might think about reducing some exposure there. With the intention of revisiting it.
Well, we have
Not
walked through
advice.
quite a bit here today, Katie, and I know that we have a lot of questions here in the chat box that we probably won't be able to get to today. But if people do have questions, they want to reach out to you, learn a little bit more about how they can get involved with what you're doing, what's the best way for them to reach out to you, Katie?
Well, I would say it's pretty easy to find us on our website. We have a contact form, so that's a great way to indicate, your own contact information, and we'll get in touch on the back of that. And Twitter or X, LinkedIn, you can find me on both, of course. And we offer free trials to our research. So we have a 1 month trial offer for anyone on this call. And we have about 6 research products that we're publishing. One is a daily and the rest are weekly reports. So we were pretty prolific, I guess, with our analysis and our writing. And we cover not just US equities, as you've seen, but just about anything that impacts them, including yields on a weekly basis, if not with a higher frequency than that. So I would encourage people to check that out. And I realized, Dan, I forgot to look at Tesla for you. So I'm going to wrap up with Tesla.
Perfect.
Oh, and I should mention also, we have an ETF. I know Barry is a fan of it. It's the Fairlead Tactical Sector ETF, or TAC, TACK. And it employs a systematic version of our methodology. It focuses on sector rotation, but also uses asset allocation to manage risk. And this is a great environment for a strategy like that. It's really shown, proof that it can limit drawdowns, which is good to see. So with the Tesla chart that we have here, you can see on the monthly, there's been a pretty good downtick in the momentum, of course. There is some support that ranges down to about 213 on our monthly cloud model. So that is one area that would be sort of a natural place for it to hold. And I noticed just recently that with this retest of this support area, we did see the MACD maintain its upward trajectory. So what that creates is a positive divergence. So I think Tesla will kick in a little bit here and participate in a relief rally. That relief rally should probably stay the same duration as just about everything else. And then ideally for long positions, I'd like to see it hold not just that 213 level, but you can see there's an additional support that's rising over time. So I'd be sort of strict, I would say, with it in terms of setting a trailing stop loss, just given the headline risk associated with it. I'll leave it there.
Awesome.
Love
Well,
it.
Katie, thank you so much for spending time with us today.
Of
We know
course.
your time's valuable. I know our subscribers definitely got a lot out of this, and really appreciate you coming on once again. So
Of
thank you,
course. So good to see you. Give my
and
best.
let's hope we hit 360 to 380 before moving higher.
I know. I'm rooting for you guys.
Thanks, everyone.
Bye, guys.
Take care.